Hi everyone, this is Michael Kramer, Mod Capital. Today is Tuesday, April 8th, and it's around 4 p.m. New York time, so it's been a wild first two trading days of the week, and the rest of the week holds the promise to be possibly just as wild. And really, I think tomorrow is going to be a fairly quiet day on the economic front, but I think given all the volatility, especially we're seeing in the rates market and everything we're seeing really going on across markets globally, I think you want to pay really close attention to this 10-year auction tomorrow at 1 p.m. Just keep an eye on how the results are. More importantly, if there's a tail or what the indirect or direct demand is, what the bid to cover ratio is, because it can give you a sense of whether there's strong demand to still own U.S. Treasuries or not. Clearly, over the last couple of days, we have seen interest rates here rise. If we look at the 30-year rate, that yesterday was trading around 434 early in the morning, was up 22 basis points yesterday and up another 11 basis points today. And you've seen the same thing really in the 10-year, with the 10-year up 20 basis points yesterday and up almost 8 basis points today. So we have a 10-year auction coming tomorrow. Then on the 10th, we're going to get CPI. That's expected to rise by 0.3% versus last month 0.2 on the core. Year over year, core is expected to rise by 3%, down from 3.1. Headlines only expected to rise by 0.1%, down from 0.2, and by 2.6% year over year, down from 2.8. And then we'll also, of course, be getting these initial jobless claims and continuing claims. Those are very important given sort of the nervousness in the marketplace around the potential recession. And then, of course, at 1 p.m., we're going to be getting a 30-year auction. Again, you want to really pay attention to these because these can be market-moving events. And then on Friday morning, we'll be getting PPI. We're looking for PPI to rise by 0.2% versus last month 0%. And year over year expected to rise by 3.3%, up from last month's 3.2%. Of the two inflation reports, I think the PPI may actually be more important than the CPI, because we know PPI holds a bunch of pieces in it that go into PCE. I mean, the CPI does as well, but we've been really seeing pricing pressures on the manufacturing side of the economy. And so if there's going to be an upside surprise, it may come in this PPI report. And then, of course, at 10 a.m. on Friday, we'll be getting University of Michigan. You want to pay attention to these preliminary numbers, especially for these inflation outlooks, as well as the sentiment. Those have been fairly weak in recent months. And so when we just swing over to what's been happening in the markets, we've been seeing these big movements and gyrations in the euro, in the dollar, in the yen, in the pound, even in the Swiss franc today. And so really, despite all the volatility, the euro actually finds itself in exactly the same exact place it's been now since the middle of March. So big move up, we've come back down. We're still kind of sitting at this 109.5 region, and we're not really seeing very much in terms of direction. But right now, when we kind of look at the momentum, that clearly still favors further upside in the euro. And when we look at the 10-day exponential moving average, we're bouncing right off of that support level. And then, of course, here's our Bollinger Band also bouncing off the 20-day moving average. And so, again, I think you have to almost consider thinking that the euro can continue to move higher, possibly towards this 112 area. When you look at the pound, also lots of back and forth. We had talked about the pound potentially moving higher. It did initially move higher, and then it came right back down again. It looks like it broke the downtrend. It broke the uptrend, and it looks like also it fell through the lower Bollinger Band. The pound doesn't look quite as bullish as the euro does, but given some of the volatility we're seeing here in markets in the U.S. and in the dollar in general, there's a good chance that it's possible that you could actually see the pound begin to strengthen again. When we look at it also, this is a big level of support around this 127 region. So I would think that as long as we stay above 127, potentially we continue to maybe favor upside in the pound. Obviously, a break of 127 sets up a move down towards this 125.5. U.S. dollar, Japanese yen. This also had a big move down following last week's Liberation Day announcements. Right now, we've been trading sideways for a couple of days. I still think that the yen is likely to continue to strengthen versus the dollar. We're clearly seeing some downward movement in the RSI. Here's your if we remove the Bollinger Bands, here's your 10-day exponential moving average. This has really been a very good guide. You can see we hit up against it today, reversed off of it, came back down again. And so again, I think if we can get below this 146.5 region, that's going to potentially set up a move towards 143. Each of the two times we've tried to get through it, we've managed to come down, but we haven't really closed below it sufficiently enough to really kind of signal that we're really breaking. You can see we closed just slightly below it on the 3rd, but we really need something a little more significant here to signal a break to 143. I think there's a good possibility, though, we're going to see that happen. When we swing over to gold, gold actually hasn't been quite as bullish as you would have expected. We were talking last week about how it was kind of overextended, and we thought maybe it would either pull back or consolidate. Well, we got the pullback, and we got the pullback right to this trend line, and that's where we're bouncing now as of this moment. At least when we think about where gold can go from here, again, here's your 10-day exponential moving average. That's clearly been rolling over. We fell below it yesterday, and that's been acting as resistance, at least as of today. So again, the key level here for gold is obviously this uptrend. If you break this uptrend and you break this level at 29.50, it could result in gold really starting to break down more materially and potentially moving back into the 2800 region. As long as the uptrend holds and the trend is your friend, and you have to think that gold continues to move higher. But the problem that I'm seeing is that, again, you have this bearish divergence that's formed in the RSI, and it's really being confirmed with the lower low here. And so this, again, sort of suggests to me that you might actually see gold begin to really break down. I know that some people would probably think this would be a flight to safety, and it can be. But the other problem, too, is that if people are in the process of just needing to raise cash, at times like this, they just tend to sell whatever they can, not necessarily what they want to. We've talked a lot about oil and the importance of this $66.50 region. Well, that clearly broke. Whoever it was that was holding it up decided to take a step back finally, smartly so, because we've seen that oil prices have fallen pretty dramatically now and are now trading back into the upper 50 region. This is kind of a key level here, because if we break this 58 area, it could set up another move down to around 52 or 53, and then we're really talking about potentially going back to around the mid-40s. So there's a lot of room here for oil to continue to move to the downside. I would note that the RSI is currently around 24, and we are below the lower Bollinger Band. Again, in a normal sort of condition, I would say that perhaps oil is likely to find some support here, maybe consolidate sideways, maybe even move back up and test one of these moving averages. But again, this isn't exactly normal trading conditions. We're seeing lots of volatility, and in times like these, sometimes the technicals really just don't work in the manner in which you would expect them to or you want them to. And so I just tend to lean more on what levels of support and resistance are doing. A break of this clearly sets up a move down to 53. As long as this holds, you could maybe retest and move back up towards the $66 region. When we look at the DAX, we just have a whole big kind of mess here. We did get the break lower in the DAX that we were talking about last week. Again, just like every other equity index, we're kind of in oversold conditions here. But again, when we're in these types of conditions in this type of environment, oversold doesn't really mean very much. So right now, what we're kind of looking at is a scenario. If we move into the hourly chart, at least, we can maybe get a better look and feel for where some support and resistance levels are. And I would argue that there's probably some levels of resistance in this area here around 20,470. Now, U.S. equity prices reversed pretty hard today, and so that likely means that we're going to see the DAX potentially open lower tomorrow, and this is going to continue to hold as resistance around 20,000, let's call it 500 for argument's sake. A break above this obviously means we can move back towards 21, but If this level continues to hold as resistance, you can see the size of the candle and the drop that we had yesterday. This was a 6% drop just from where we closed. So this was a very big move down. Obviously, if we were to see this hold, I couldn't envision the DAX kind of coming back down and retesting these lows in the 18,000, call it 600 to 700 region. When we look at the FTSE, there was a lot of things that broke here. Here's what it looks like, a kind of rising wedge pattern that clearly broke. We also were talking about, the consolidation wedge that was forming there. That clearly broke. When we look at the daily chart, we basically have undercut, all these lows that were in place at around 8,000. We've moved all the way back into where we were trading throughout most of 2023. It looks like, again, this is an important region because this is the highs of 2023. If we go back and we just mark this level here, it kind of makes sense that we saw the FTSE make attempt to bounce off of this level. Again, the 7,600 level seems like in a very important spot given it was such an important level of resistance going back for a really long time, and a bunch of breakout attempts failed there. I mean, when you look at it from this perspective as well, the next level of support looks really strong when you get to this 7,200 region. So if you can't get the FTSE to bounce off of this 7660 region, I think you're looking at a move back down to 7,200 or so. Again, oversold or not, these types of conditions really just don't matter. Traders will sell what they can sell, not what they want to sell. When we look at the S&P today, that was also a pretty rough day. We actually were up nearly 4%, a little bit more than 4%, and we ended up closing down over 1%. So this was just a really big reversal day, and here you can see it a little bit more clearly. We gapped higher at the open and reversed pretty hard going into the close. And actually, we closed even lower than where we were yesterday. So this is overall just not a very pretty looking picture. And when we look at it from this perspective, the way that I'm thinking about where the S&P 500 is right now is that this was the August lows. And this was serving as a little bit of a support and resistance zone through most of the day yesterday. And you can see that even today, this region came into play. This whole area in this 5,075 to 51 and a quarter region really was in play most of yesterday. We tried to get above it today. That failed. We came in and consolidated around it, and then we basically broke below it. And really more importantly, we also managed to basically close right around all of these lows. So this is a fairly negative pattern. And I would also tend to think that, and so when we think about that, the next area of really support on the S&P comes at 4,800 just because it marks the December and January of 2021 and 22 highs. It also marks a level of resistance in 2024. If that were to break, then I think we're looking at a move back to 4,500 or so and potentially a gap fill at 4,400. I know that's a long way down, but at least that's what the technical suggests if we don't find support at those regions. And when we look at the NASDAQ, also a very weak day, down over 20% at this point. Again, this is a key level of support. This marks April of 24. Clearly, today we closed just a little bit above that, so we bounced a couple of times off of it. When we look more carefully, you can also see this is just right around where the highs were in November of 21. So this is, again, another important level of support and resistance for the NASDAQ. If this can hold, I think you can make an attempt to maybe get back up towards the upper end of the trading ranges today, maybe even up to 18,400. Again, but the problem is that today's reversal was pretty mean, and we have this giant gap to fill at 15,450, and that basically takes you back to where we were in July of 2023. When we look at the Dow, that was also weaker today, but not quite as much, just 80 basis points. This is a key level of support. We already saw the Dow test the January of 22 high. Again, if these levels don't hold, I think we're talking about potentially filling this gap down here at 34,300, or potentially returning all the way to the October of 23 lows. I know that seems unimaginable at this point, but there's just not a lot of support in this region to really slow things down if we start seeing these levels break, especially if you see a significant prior top get taken out. It's a pretty negative sign. So we'll just, again, keep an eye on everything, do the best we can, and we'll be back next week. Have a good one. Bye.